Welcome everyone for this general market update. It's Sunday, January 16th, 2022. I'm John Pocaroba, and I wanted to do an update for you. Just a quick disclaimer, I'm an amateur individual growth investor, and I'm not affiliated with IBD or MarketSmith. And this presentation is being made on behalf of Rain King LLC. So I'll always start with the general big picture market overview. So the January 4th meeting went over the details of a super cycle, and I used the precedent of 1974 to 2000, and I'm going to actually refer you to the details of the discussion of the super cycle in the January 4th meeting, so we can spend more time today on a lot of other material I'd like to cover. I've compared the super cycle to 2009 to potentially 2020, 2035. So I wanted to start with the psychology of the market. As a bull market starts, you kind of go through this roller coaster and you slowly build as the market goes higher. And that's because greed as an emotion kind of is a slow build. It's slow build until you eventually reach a state of euphoria. And you'll notice that, when things come down on the opposite side, the roller coaster gets very steep. And that's really because fear is a much stronger emotion, and you'll get more of a panic selling situation. This particular market that we're in, which began in April of 2020, probably reached euphoria back in February of 2021. And we're somewhere in this period here of, a topping process where anxiety kicks in and it becomes a much more difficult market environment. As we saw back in 21, the trading was much more difficult. So I recently had tweeted something from Justin Mamis. Justin Mamis was a market technician. He recently passed away, and I think it was 2019. He was about 90 years old at the time, but he created this thing called the sentiment cycle of bull market tops and bottoms. And I'm just highlighting kind of some of the sentiment when you get to tops, where there's, the buy the dip mentality, the market starts to get more choppy, and there are subtle breakdowns that start to occur. And there's this disbelief that what happened to the bull market. So when I start to look at that and kind of compare it to where are we today in our market cycle, which we believe is late stage, you can see that, the market had a rally attempt that got turned away, and we kind of had the second rally fail officially in this period here. And if you draw just a simple trend line, you can see that we've broken below this. And if you correlated it to the Mamis sentiment cycle, we would be in the overt warning disbelief stage of the sentiment cycle. Not predictive, it's just an interesting relationship of sentiment. So I wanted to turn our next attention to growth stocks and the life cycle of a growth stock. And this quote from Darvis is really important. The biggest factor in stock prices is the lure of future earnings. The dream of the future is what excites people, not the reality. This is what it's all about for growth investing, earnings and sales. And you'll notice as a stock comes out of a base, if we come out of a bear market, you'll get a number of things on the way up. You'll get positive earnings surprises. The estimates eventually get raised up higher, and the stock has earnings per share momentum. Gradually, as at market tops, growth stocks lose their momentum and they start to guide lower looking ahead. And that's where analysts and institutions starts moving their monies out of growth stocks. And it's not until way down the other side that, the momentum is completely lost and the stock has already declined. There's a rule for growth stocks. It's called the 50-80 rule. And really what it says is when leading growth stocks top, there's a 50% chance they will decline 80%. Sounds unbelievable, but historically it's true. Also, there's an 80% chance they will decline at least 50%. So I'm going to show you an example of this. Here is Netflix in 2011, and you'll notice bull market, look at the EPS, strong numbers, and it's right near the top of the stock that Netflix had a great earnings report, and it beat by 14 cents, but it guided lower. And that was the key thing, guiding lower. And that actually turned out to be the peak in the stock. And you'll notice slow build on the left side and things turn pretty ugly on the right side. And you'll notice that the next earnings report was, again, a great report. They had an EPS of 66. They beat by 22 cents, but they guided lower again. So what's important about this is fundamentals will always look good at the top. And you don't use fundamentals to sell growth stocks. We always look at the technicals only when we sell. We're looking for sell signals, and you're going to have to be willing to part with your stock when you see sell signals on the chart, and don't wait for the fundamentals to change, because they won't change until way on the other side. Analysts and institutions have this type of information way before the public. So many people, these are some big growth stocks that have really come off their highs. C Limited is off 55%. Roku is off 67%. Shopify, one of the greatest winners since 2016, is off 40% off its highs. Some people say, well, geez, these stocks have to bounce. I want to really warn people, don't fall into the trap of looking at former big leading stocks and think they are bargains and they are cheap. They can go lower. There's precedent for this. And if we were to look at the March 2000 top in the NASDAQ, some of the biggest leaders, Cisco Systems, eventually became off 86% off its highs. It sounds unbelievable because Cisco is one of the biggest winning stocks of the 1990s. Oracle, 78% off its highs. And Amazon, which was a young company, 95% off its highs. So don't try to predict how low a stock can go. Let's look at a couple internals of the market. Simple chart. This is a measure of new highs minus new lows on the NASDAQ. And the bars are just showing the number. If they're headed down below zero, these are net new lows. And on Friday, we had a net new lows in the NASDAQ of minus 600. To keep it really simple, it's really an unhealthy picture when net new lows in the market. And you can see the index is getting into trouble in here. The AAI is a American Association of Individual Investors. So it's really a measure of retail sentiment. So I thought this would be an interesting chart to show. If we're above the zero line, kind of in green, that means individual investors are bullish. And if it's in the pink, they're bearish. You'll notice that, late October, early November, everybody was piling back in, including the public, because the rally was looking really, really good at the time. But as we know, that changed in a big way by the end of November with the Fed making some of their announcements. But what's interesting about this to me is the current number of bears does not even exceed the September bear level, and the market has already significantly deteriorated. Sentiment is not something it's primary to me. It's probably tertiary. It's just a note of an interesting data point. So the current market, I want to get into a couple of key concepts before we get into the actual looking at the indexes. And I wanted to talk about market tops and market bottoms. I had tweeted recently that market tops are a process where the market doesn't just stop going up. It gets choppy, and over a period of months, the markets kind of make rounded or tops that are a process. Now, market bottoms, conversely, tend to be an event. There's usually waves of selling, and then eventually there's a capitulation of selling. So as markets top, growth stock leaders usually lose top leading stocks. 1/3 of them will probably top before the index tops. Another third of the top leading growth stocks will top kind of coincident with the index topping out. And then the rest will really come down on the decline as we correct. Market bottoms, there's usually waves of selling down, and they're fairly steep. Eventually, there'll be a capitulation where all the sellers get sold out, and there's really a washout of selling on usually very high volume. After that happens, without any more sellers in the market, even a small amount of buying can start to induce a sharp rally, and sometimes you'll get sharp V's off the bottom in a bear market situation. So that's the concept. So I recently tweeted about volume, and as the NASDAQ was starting to have large percentage drops, and they were actually on low volume. So I wanted to talk about changes in trend and some volume clues. At the beginning of a bull market, when a stock breaks out and we start to advance, low volume pullbacks are exactly what you want to see in the early stage of a new bull market. That's constructive. There's stronger volume on the way up. Brief, low volume pullbacks are really, really good. Once you reach kind of a period where the market is getting into trouble and potentially topping, large percentage drops in the index on low volume are actually more concerning. And the reason that they're concerning is because they're starting to reveal that there are no bidders underneath the market, and that only a small amount of selling pressure can hit the market fairly hard. And we'll look at the NASDAQ in a moment about this concept. Eventually, as the market really starts to roll over and break, the breakdown becomes more obvious to everyone, and that's when the high volume declines start to kick in as fear and panic take hold. So here's the NASDAQ as of Friday. I noted that a 3.3% drop on this day here actually came on lower volume. That was concerning. And then we had another 2.5% drop in the NASDAQ. Again, the volume lower, which is even more concerning, revealing very few bids to hold up this market. I've also noted a couple reference points. A 10% from the all-time highs of the NASDAQ is what we touched early in the week. If we were to come down to the October lows, that would be about a 11.7% correction. Contextually, a 10 to 12% correction is still normal in a bull market cycle. Now, we don't know at this time if the market is going to come down potentially and basically find its footing. It may find its footing and really consolidate, and maybe we go higher. There's also a possibility that the market deteriorates even further and we get some bounces, but actually we go much lower towards a deeper correction, or maybe a better market. The point is, nobody really knows where the market is headed. All we can do is observe the action, and we have to really be open to evidence on both sides, whether it's a bullish scenario and we consolidate, or it's a more bearish scenario and we're headed lower. A couple of key levels and some key stocks and ETFs that I would keep an eye on are some of the leading stocks left in the growth sector. This chart is showing, this line is Tesla, and Tesla has formed this double bottom. But what's important to me is there's this zone of support that keeps holding in Tesla between 1,000 and about 1,025, which is right around the 1 trillion valuation. I would watch this stock carefully. If it breaks down, that would be very, very bad, and probably be another leg down for growth stocks. Apple is this purple line. Apple has been kind of dancing with the 180 price level, where it's been rejected at least 4 times. 180 is important in Apple because it represents the round number of $3 trillion valuation. Apple has held up well given this correction, but if it rolls, that's a bad sign for the market. The SOX index has been probably the leading tech area of the market. It came down to a support level last week, and it got support, which was really, really important. Again, I'd watch this carefully as it tries to rally. If it rolls, it's bad for the general NASDAQ composite. You'll notice that the NASDAQ, meanwhile, is making newer lows along the way, and a downtrend seems to be in place. And I also note one of the biggest leading stocks of the last 5 years has cracked wide open, and that's Shop. Again, a big winner, big leader, has now really rolled over. Now, conversely, the S&P is the stronger index at this time. And you'll notice that the S&P really came down and only had a 5.2% pullback, which was really benign compared to the NASDAQ and growth stocks. It's starting to, it still wants to hang in there and possibly make a move higher. If it were to come down, a reference point might be, again, the October lows are about 11.2% correction. If the NASDAQ or if the S&P 500 were to correct. So we know that the cyclicals are really the place to be in the S&P 500, and that's oil has been strong, energy has been strong, materials, and even some of the defensive sectors like consumer staples, real estate, and healthcare. And again, this is just a line chart showing how these sectors of cyclicals have really been outperforming and really helping the S&P stay afloat. But they are late stage sectors. I showed this in my last video, but I'll share it again. Big picture context, the S&P has made a big move of 117% in about 21 months. You'll notice though, we're getting some distribution on the way up. So that's important to note. And I also noted the 5,000 round number, which could be a very psychological level. Sometimes markets will either top or bottom at psychological round numbers. I mentioned that that was still about a 5% move away for the rally that could occur in the S&P 500, and it probably would be led by these cyclicals, the financials, and maybe some of the defensive stocks. So I know rising rates is seen as the driver of the weakness in the market. And I wanted to just share two charts on rising interest rate environments. This is the 2004-2005 period. And I've noted where the Fed started to they made 5 quarter-point rate cuts, or excuse me, rate hikes. And you'll notice on this chart, as these rate hikes were happening in the yellow zone, stocks are a forward-looking mechanism. So they're looking ahead 6 to 9 months. And you can see stocks started to get very choppy and indecisive before the first rate hike. Once the first rate hike took place, you can see here the black line is the S&P corrected about 8%, and the NASDAQ came down almost 18.7%. But I think what is really interesting is you'll notice that while rate hikes are still occurring, the stock market started to rally. So that's interesting to note. And I've also looked at the next slide, which is a different period. This is the 2015 through 2018 period. Now we were coming off a very, very low Fed rate. But you'll notice that the Fed hit this gray line. It shows the rate increases that were made in 2016, 2017, and in 2018, they got more steady. So as the rate hikes there was no rate hike, you could see the market is starting to correct because it's looking forward to what is the impact of rate hikes on the economy. So again, the S&P came down 15.2%. The NASDAQ came down 19.5%. And if you traded during 2015, it was basically a stealth bear market in growth stocks. It was a very tough environment. Now, again, as rate hikes started to happen, and they're gradually happening in 2016, 2017, notice how the market rallied and stocks did really, really well. And you can see the black line is from the bottom here, the S&P was up 58%. The NASDAQ actually had a 78% move, which is quite impressive as rates were gradually moving higher. It wasn't until the rate hikes became steadier and that late in 2018, the market really got in trouble and we had the 2018 bear market. So, there's a period where the market is trying to figure out, where rates will affect the economy. The Fed has a challenge right now of trying to tamp down inflation, but they also don't want to kill the economy. So we'll have to see how it plays out. But starting at such a low base does not mean that we're automatically going to be in a bear market. Again, putting it in perspective, this is the NASDAQ on a monthly chart. And I've circled. This is that 2015, 2016, 2017 period that was the stealth bear market where rates were rising, but growth eventually found its footing and we moved higher. That could happen. The other thing to keep in mind is within the super cycle concept, we could have multiple corrective phase and come probably all the way back down to the 11,000 level in the NASDAQ and still be in the super cycle. So it's helpful sometimes to zoom back out for perspective. I want to thank everybody for attending the video today. Hopefully it was something that's useful to you. You can reach me on my YouTube channel, or you can see me on Twitter. And I wanted to make sure that everybody knows if you have feedback or if you have comments, they're welcome. And I hope to see you at the next general market update.